Let's get to shareholder perspective. We've got Murray Leith of Odlum Brown joining us. Murray, it's not every day that we see a Canadian bank drop 8%. Does that speak to the maybe tolerance or intolerance of investors these days when it comes to any sort of credit unpleasantness?
Perhaps. I think one thing that people might not realize is that BMO was the most popular bank coming into today. 14 of 17 analysts had a buy rating on it, and that was more than any other bank had buy rating. So the disappointment and the shock on the credit quality front caused a really severe reaction on what has been a generally a tough day. So we don't see moves like this in Canadian banks very often.
Now the question is, what do you do? Is it an easy buy the dip opportunity, or would you be cautious?
Well, our clients have owned banks for years, decades, and they've been fabulous investments. They're great businesses. It's an oligopoly here in Canada, so they're very profitable. Balance sheets are very strong. They're very well diversified. They pay great dividends that are dependable and regularly get increased. So they're great long-term holdings. I don't know that they're going to be as good of businesses to own over the next 10, 20 years as they were the last couple of decades, but I still think they'll be among the top businesses in Canada in terms of stocks to own. Now that's the long term, and we're long-term investors, and if you got huge capital gains in it, you don't want to be trading in and out of them. But we've been advising people to be underweight the Canadian banks. They are cheap compared to historical norms, but they're cheap for a reason. Canada hasn't had a credit cycle, a housing cycle for 3 decades. Our economy is weaker than the U.S. economy, in large part because our consumers are a lot more levered. We have a lot more exposure to variable interest rates. Our houses are expensive and unaffordable. So Canada as a whole, our economy is more vulnerable, and a lot of that's discounted, but there's a risk that, it could be tough for a few more, for a number of quarters. And, I think that's what people heard today. In general, investors, it's been a great year for stocks in general. U.S. stocks are up 15%. Canadian stocks are up about 6%, which isn't nearly as much, but that's still not a bad number. But people have been discounting the Goldilocks scenario. And, things could be tougher economically in Canada, and that could weigh on the banks. So we think you still own them, but we're underweight. We've been preferring other areas of the market, and that's served us well. Our model portfolio here at Odlum is up 15% for the year to date, and that's on the strength of stocks in other areas of the market that we favored.
And I'm going to ask you what those are. But first, I want to get perspective on that point that you made, that the next couple of decades for the banks might not be as great as the past couple of decades. And I think for people who are long-term shareholders feel like, well, we've seen this before, and every pullback is an opportunity to add, because historically it has been. And it sounds like you're trying to communicate we're in a totally different era now.
I wouldn't say totally different. Maybe I'm trying to get cute and time these things better. I think we'll look back in 5-10 years, and the banks as a group, and probably all of them individually, will produce good total returns, including those fat dividends. But I think one might want to be patient before, certainly moving back to an overweight position. And I think we have time. I think there's other areas of the market that can do better in the interim.
Let's talk about those other areas. What's your most preferred right now?
My most preferred stance is to be broadly diversified, quality companies. But, for a long time, it was own the best. Don't worry too much about price, ride the winners, and that was the strategy that worked. We're in a different interest rate environment, inflation environment, and I think price really matters. And what we've seen over the last number of years is that the valuation spread between the best and the rest has gotten wider and wider. And I think it's, just owning the best stocks, that's very popular. You pay a dear price for that. And I think it's going to be difficult to beat the market with such a strategy going forward. I think there's got to be a lot more focus on the trade-off between growth and the price that you pay for it. And so that's where we've been focusing our attention on. We own Mag 7 stocks, 4 of the 7 Mag 7 stocks, but we're underweight them modestly. Trying to find other areas in the market where there's a better trade-off between the price you pay and the growth that you get.
Did you find it?
Yeah, we're finding it. Like some of the renewable clean air and energy areas of the market, like Brookfield Renewable, the whole space was hugely out of favor. Got really beaten up a few weeks ago. It's had a huge rally. So, averaging down on those things when the baby was getting thrown out of the bathwater has helped. We've been playing the aerospace theme by owning names like GE Aerospace, which makes jet engines, or TransDigm, which makes aftermarket parts for all the major airlines. Those stocks have done very well as travels come back.
Let's talk about that renewables play, because that's also become sort of a quasi-AI play as well, on the expectation of a pickup for demand. And I'm curious how you think about that, and whether there should be a healthy dose of caution for people who think they're going to buy utilities for AI exposure, only to be run over if the U.S. 10-year yield, crosses 5%, crosses 5.5%.
It all comes down to price. And, I think the utilities were discounting an expectation long ago that rates were going to stay higher for longer, whereas the rest of the market was discounting an expectation that they were going to cut 7 times this year. So the utilities overcorrected on the downside, were very cheap. And then people started to realize, like, hey, wait a second, electricity demand's going to go up a ton with all these data centers that are being built, and that's going to benefit the industry. So they were simply too cheap. But yeah, if interest rates went up a bunch, that puts pressure on the whole market and companies that pay dividends, perhaps more so. But it's the starting valuation that matters.
Murray, thanks so much